Hey, it's David here from Freedom Founders. I want to talk about the 401k and your lost opportunity. I know that most of you hear from your financial advisors, your CPA, whoever helps you with your books and your taxes, that when you get to a point when you start paying taxes from your business that is becoming more profitable, which is a good thing, right? That no one likes to pay taxes. We hate to do it. We want to mitigate or lower the amount of tax burden that we have if at all possible. So what happens typically is your advisor or CPA will tell you, well, hey, we can start up a 401k, do an office 401k, and you can put quite a bit of money in that, and as you put that money in, you get a tax deduction for that particular calendar year, and that's going to reduce your taxes. And now at the same time, you're loading up this retirement account year by year by year, and if you're a wise investor, that's going to build up, and that's going to become your retirement nest egg. And that's all true. That's all true. And if that's the only thing that somebody does, if it's the only thing you're going to do, because it requires discipline to do that, and discipline is a good thing, if that's the only thing you're going to do, then I think that's great. It's a great start. It is far better than doing nothing at all. So when I downplay the 401k, I only do it because there are better strategies and better opportunities for some of you. For some of you that have the time, propensity to learn how to get better returns on your money. Again, this is not for everybody, not where you are right now, but for some of you, this will make a lot of sense. So listen closely. When you put money in a 401k, you essentially have taken that money and taken it off the table out of your zone of influence, and you put it inside a shell, or I like to call it a prison, because that money is now off the table for you until you're 59 and a half. There are a few exceptions when you can take that money out for particular needs, but other than that, if you take it out before 59 and a half, you pay not only taxes on that money at your current rate, but you also pay a 10% penalty. So it's set up a construct. The 401k is set up as a construct to take that money that you put in today and get that tax deduction, but it takes it off the table. You can't really get to that money. And what if you have a better opportunity? What if you could take that money that you have dutifully put into your 401k for 2, 3, 4, 5 years, and all of a sudden you have a great opportunity to expand your business, or put more money in your business, or buy multiple businesses if that's what you do. But now that money's locked up. You can't get it. You have to go to capital investment resources, go to banks, and borrow money if you can get it. If you have that money to put into your business, I'll bet you could get a far better return than you're getting in whatever mutual funds or annuities or bonds or whatever your money manager is putting that 401k into. You can get much better return in business. In fact, a good business model, investing money in that business, you're going to get a minimum of a 50% return up to 100% plus. That's the rate of return, the real return on good business models. Can't do that in the stock market. In fact, we can't even do that in real estate. We can get close sometimes to 50%. Some models, if we really hit a home run, we can get higher than that. But overall, if we shoot for a 15% return in real estate, we feel like we've done very, very well. So first place is don't let your money get locked into a prison, and don't let the tax tail wag the dog, meaning don't let the fact that you're paying taxes today keep you from keeping that money where you can get a better return. Now, one reason I would have you do a 401k is that once you get the money in a 401k, you can turn around same day, next day, next year, whatever, and convert that money into a Roth IRA. Now, you've got to pay the tax, but it's a way to get a chunk of money into a Roth IRA very quickly. Otherwise, the contributions to a Roth IRA are very small per year, and many of you, because of your income, can't even directly contribute to a Roth. So we call this the backdoor Roth IRA. Don't want to get complicated here, but just keep in mind if you've already built up a 401k, you've got it there, you can at least convert some or all of it, whatever you want to, talk to your advisor, into a Roth IRA. And now, when you're working that Roth IRA money, that money will come out at distribution time, age 59 and a half or above, totally tax-free. The money in your traditional 401k is going to come out with tax liability. You're going to have to pay tax on those distributions, and the problem there is we don't have any idea how high tax rates will be. I can promise you one thing, they will never be lower than they are today. So think hard before you decide, well, I'm going to put the tax bite on down the road, because in this case, kicking the can down the road may not always be the best idea. Again, everybody's individual situation will be different. So I'm giving you an overall construct. You still need to talk to your tax advisor, but just don't always buy in to what the mainstream media, to what the majority say about why 401ks are so great. In some cases, they can be a good thing to get started with. The discipline's great, but in many cases, following down that road leads to higher taxes down the road, and much lower returns on investment than you could do in your own business. That's it for me for today. Remember, always stay focused on your freedom. I'll see you next time.